Stocks, bonds, and real estate. Stocks. Many organizations choose to sell shares of stock to investors in order to obtain funds for their company operations. Investors receive a tiny percentage of ownership in the firm in exchange for their money, equal to the number of shares they acquire. The value of the shares improves over time if the corporation uses the cash efficiently and invests in successful ventures. If the firm loses money or goes bankrupt, the stock's value may fall. Stock in the largest firms can be publicly traded, meaning that anybody can buy and sell them on stock exchanges such as the New York Stock Exchange or Nasdaq. The price of a publicly traded share of stock is influenced by the company's profitability as well as news or economic data that may influence the public's opinion of future profitability. Stock investors can buy individual shares in a particular firm, such as Apple, or invest in a range of sector-specific, transportation, for example, or index mutual funds and ETFs. As a result, citing a return for the stock market might be problematic because it varies greatly depending on the investment decision. Bonds. A bond is a debt instrument offered by an issuer and held by a bondholder. In other terms, it is a loan granted to a bond issuer by an investor. The issuer commits to repay the principal, face value, plus interest over a predetermined period of time in exchange for the loan. Bondholders, unlike stocks, have no ownership stake in the issuer, so they don't necessarily profit from the issuer's growth, but they also don't experience much of an influence during a contraction period, as long as the issuer has the finances to make their needed payments. Governments and companies are the two main types of bond issuers. Government bonds, also known as municipal bonds, are issued by government entities that utilize the cash to pay community projects such as roads, bridges, sewage systems, and parks. The power of the issuer to charge a tax and utilize the proceeds to repay the issuance is supported by government bonds. This is considered the safest sort of bond, as the only possibility for it to fail is if the government becomes unstable or if there is a severe recession. Corporations issue corporate bonds in order to raise funding for initiatives or items that will improve their income. This cash might be used to develop a new factory or launch a new product, for example. Because a firm is more likely to go bankrupt and so be unable to pay bondholders, these bonds are not as secure as government bonds. Bond investors also have a variety of alternatives to pick from. They may buy individual bonds from a corporation or the government, or they could buy a bond mutual fund or exchange-traded fund, ETF, that holds a variety of bonds. Commercial real estate. The phrase commercial real estate, or CRE, refers to a category of real estate assets bought with the goal of profiting from cash flow, capital gains, or both. The basic principle of a commercial real estate investment is that a property is acquired for a specific price and financed using a combination of loan and equity. The property's space is leased to other firms, and the rental money is utilized to cover operating costs such as taxes and insurance. If there is any money left over at the end of the year, it is disbursed to stockholders. Investors in commercial real estate have a variety of possibilities as well. They can buy a property outright, which is similar to buying an individual bond, invest in a real estate investment trust, REIT, which is similar to a stock or bond fund, or even invest with a private equity company, which is a unique alternative investment arrangement. The importance of diversification and product/investor fit. Each investor is different, each is at a different stage of life and has distinct wants and goals in mind for their investment. Younger investors may be able to afford to take greater risk with their investments since they have a longer time horizon. As they approach retirement, older investors may have a shorter time horizon and prioritize wealth preservation and lower risk possibilities. It is essential to understand an investor's risk tolerance, time horizon, return expectations, and liquidity needs before choosing a certain form of investment. Moreover, we are firm believers in the value of portfolio diversity. This involves distributing an investment portfolio's contents among multiple asset classes in order to capture each asset's unique risk/return profile and generate a high overall return. A broadly diversified portfolio of risk assets, such as stocks, bonds, and commercial real estate, is the best option for most people.